let me just introduce quickly myself, Giovanni Denaro, University of Milano Bicocca, Department of Informatics, Communication and Computer Science. And I mean, it's my pleasure to introduce this initial session of the conference. So first of all, welcome everybody to the conference. Let me greet you on behalf of the university, of course my department of computer science, and also I want to thank the Department of Business Law, the Professor Paola Bongini that is organizing the event, the sponsors, the Digital Gold Institute, the Crypto Asset Lab. So we start. The beginning of the conference is with a session in which we will have presentations from the PhD students. And you know, I guess this is a good way to get into the many angles of the problem that is related to the blockchain technology, the digital ledger technology. As Paola was saying, I represent the university in this national initiative, which is called the National Interest PhD Program on Blockchain and Digital Ledger Technology. And I mean, it's a PhD program that is managed at the national level, but the students that are hired, then they get, they develop the research at the host universities. And I mean, they work on many different things. There are, you know, people that are more interested in the computer science aspects. We have other students that are, you know, more on the financial markets, the centralized finance things, you know, lawful problems. And the interesting thing is that we have events in which they join together and they speak with each other and they kind of cross-contaminate between themselves. And it's very interesting to, you know, participate in those events and see how people interact and, you know, get kind of knowledge that is not maybe central to their research, but is, you know, part of the basement of what they're doing. So I mean, as a computer science, a scientist, I'm more interested in things like, you know, the consensus protocols, the many applications framework, the foundation of the technology. But you know, the main use case of this kind of technology maybe is in financial markets, in, you know, decentralized finance. So there are a lot of problems in there. And you know, the people involved, there are new processes, new lawful frameworks. I mean, also that is a part of the problem. So what I think is that this type of session is a good way to start because we can see many different things from many different angles. So I just wanted to, you know, say this to introduce, and then I want to start with the presentation. So I leave the floor to Sabrina Leo, who will introduce the first session. Sabrina, please, the floor is yours. Thank you.
Thank you. Good morning for inviting me at this doctoral symposium, colloquium. I study the application of DLT at the banking system in the whole life of the banking system. I'm glad for the invitation to coordinate this session. So, if you are agree, we can move to the presentation. So I invite Ali Benami or Matthew Yorka. Ali, okay, Ali. The floor is yours, and Ali present a paper titled Global Dynamics and Determinants of Cryptocurrency Adoption. Ali, you want, please? Thank you. You have 15 minutes or 20? You have 20 minutes. For your presentation, and after we have Q&A session of 5-10 minutes. I'll check you. Okay. So the second, the second paper. Okay, Andrea, I suppose. Okay, which present the second paper that shift with an answer if crypto are gateway barrier.
Yeah, sure. Okay, so good morning, everyone. Really, the title of the paper is a little bit different from the one you can see on the program because I continue to work on it, and I think that's this title is a little bit better. Okay, so I write this paper with my PhD supervisor, Professor Franco Fiordelisi and Saverio Centella Lopez, and I want to start my presentation with this image. Okay, so this is a financial article, a Financial Times article, talking about the case against the SEC and Ripple. And at the end of the case, the SEC conclude that when the token sold by Ripple is sold to some financial institutions or institutional investors, it must be registered as a security. While when it's sold to retail clients, no. So from here, the most important research question of our paper, that is, are now cryptocurrency primarily used as an alternative form of investment assets or a form of digital currency? Well, the literature is not very clear about that point because there is a paper from Bias that show that the Bitcoin price drivers are both the possibility of buy goods or services using it, sorry for the shoulders, the possibility to buy goods or services using it, or speculative purposes from investors that want to reach high capital gain or returns. Now, it has been shown that for the first year of its life, Bitcoin is used for illicit transaction in black market, to buy arms or drugs, for example. But most recent papers starting to focus on investment future of cryptocurrencies, most of all on classical risk factors, and in particular on the market problem, price manipulations, or unregulation of that market. So also the literature is not clear about the primary use of cryptocurrency right now. Another evidence is that it's possible to buy cryptocurrencies using ATM with cash. And I discovered that there is a cryptocurrency ATM here in the Bicocca village. I didn't know that. And okay. And like another fiat currency, for example. But also, again, we don't know if people choose to use these devices to buy or sell cryptocurrencies and using them as an investment asset or an alternative form of currency. But we choose to use the number of these ATMs in a specific area as a proxy to measure the adoption of cryptocurrencies in that area. Why this? Because we know that blockchain is a public archive, we know about the transaction, about the senders, the recipient, but we don't know the precise location where people that use blockchain are. So with the ATMs, we have a precise location, so we can measure the adoption in that area using the number of these ATMs in that area. Because we think that producing ATM, install and have this ATM inside a shop, a supermarket, or mall have a cost. So if in a specific area there is a higher number than another one, we can assume that here the demand is higher than in another zone, okay? So this is the photo, the screenshot of the presence of this ATM in the United States in 2022, I think. And we download this data using the So we use a difference-in-difference framework. We have our treatment period that is represented by our variable post that equals to 1 from, that equals to 1 from each year from 2021 to 2024. And we have our treatment group that is represented by the variable LTS that stays for low tax state. That's equal to 1. And are those states that have an average capital gain taxation lower than the national average, okay? So this is our model. This is the coefficient of interest. And here we have a vector of some control variables that are the number of households and the mean income of the households. We do not use the population of the area as a control variable because even if the taxation is a state level, we use as measured the number of ATM in each congressional district of the states in the United States. And congressional districts border are created each 10 years to consider the density of population. So our measure is consider implicitly the population of the area. So when we use a kind of model, we have to check the most important assumption, that is the parallel trend. And here we can see that before the event, the average number of ATM in congressional districts of treated and controlled states is the same. After the event, we have an explosion, but there is a higher increase in treated states. So parallel trend assumption is confirmed. And here there is a t-test on the average, and we can see that the average means it's not different, significantly different from 0 before the event, but yes, after the event. So we have the parallel trend assumption. Here, the result of the coefficients. So we have the coefficient of the interaction between our treatment variable and dummy ER variables. We can see that the coefficients are not significantly different from 0 before the event, and starting to be positive and significantly different from 0 after the event. And here we can see the value of the coefficient. So the model is implemented 4 times. In the first 2 columns, we do not use control variables. We only change the fixed effect from a state to congressional district fixed effect. And third and fourth column, we add also the control variables. And we can see a positive and significant coefficient. So it means that after the event, that is the entry of institutional investors in cryptocurrency market, there is a general explosion in cryptocurrency adoption measured by the number of ATM, but this adoption is around 40% higher in state with a low taxation on capital gains. So from here we can conclude that only from this result that now in the United States cryptocurrency are only so as an alternative form of investment. But we can also ask, if possible, that there are some state characteristics or inside state characteristics that can correlate with the low taxation. So we add an internal shock in the state, and we consider also the presence on each congressional district of an incumbent representative to the House of Representatives of the United States that declared to be pro-cryptocurrency. So we want to see if the favorable politics over the taxation can have an additional effect. So we have a measure, we collect the data about the elections. So we have each candidate for each election in our period. And we start from this website. This website do a kind of text analysis on politics statement on social media to classify them in pro-cryptocurrency or neutral or anti-cryptocurrency. So we create a dummy variable, 0 or 1 for pro or not, and we have this second model. So here we have 3 coefficients of interest. The first variable, pro-crypto in low tax state post the event, is represented by these characteristics. We have non-pro-crypto in low tax state post the event, and pro-crypto in high tax state post the event. And here we have 2 important different results. The first one is the second row, because in the second row we saw the same thing we just saw before, so that in low tax state post the event we have the adoption of cryptocurrency. But the most important thing is that if we add the characteristics that congressional districts have an incumbent politic that declared to be pro-cryptocurrency, there is a higher coefficient. So an additional effect on the diffusion of cryptocurrency. But if we have a high tax state, the mere presence of a pro-cryptocurrency candidate do not have any effect. So we conclude that a favorable polity can have an additional effect, but only in the case where at the base there is just a favorable investment environment for cryptocurrency. Okay? Now, some robustness test. We want to know if people declare to use or not cryptocurrency and for which reason. So we have the data about the SHED, that is the surveys of household economics and decision making in the United States. And starting from 2021, they had a question, sorry, 2 questions inside it. Do you have used cryptocurrency to buy goods or services, yes or not? Do you have old cryptocurrency for investment, yes or not? Unfortunately, we cannot use this data to implement again a difference in difference approach because we do not have any data before the event, but we can only use for a robustness test. So we create 2 models. The dependent variable is a dummy variable equal to 1 for whom hold cryptocurrency for investment or for whom who use cryptocurrency to buy goods or services. These results confirm our first results because we saw that starting from 2023 and 2024, in US, people declared to increase the hold of cryptocurrency for investment purposes, and the coefficients remain positive and significant even if we add some control variables. But if we consider crypto user, there is not any effect. So this robustness check results confirm our first results and confirm that now in the United States, most of all starting from 2021, cryptocurrency are used as an alternative form of investment. Now, there is another problem, because this ATM, in the majority of the cases, not always, but most often are installed in border areas between states, in suburban areas of big cities, or in some nightlife areas. So a lot of time, this ATM have been connected to money laundering, starting from illicit activities. So we ask, if possible, that the explosion of this ATM could be connected to an explosion of criminality in a specific area. So we re-implement the first model, but using another treat variable. In this case, the treatment variable is HES, that stands for high crime states. So we collected the crime index of each state from the FBI website, and this variable is equal to 1 for those states that have a crime index higher than the national average. This crime index is both for violent crimes and non-violent crimes. We implement this model using both of them. Well, we did not expect that there was any results with violent crime, but for non-violent crime, for example, drug selling or other things like that, could be some results. But using violent crime, we have not any effect. Only the control variables that are the same of before are significant. The same thing using violent crime, non-violent crime index in those states. So we can conclude that there is not a significant connection between the criminality in an area and the diffusion and the adoption of cryptocurrency. So a fast recap. Now, considering the previous study, cryptocurrency occupy a position that is a kind of borderline position between alternative currency or alternative formal assets. Originally used for transaction in black market, now literature are focusing on investment future of cryptocurrencies. And we used to measure the adoption using the ATMs for each reason that I just said. The entry of the institutional investor push the attractiveness and the trust to cryptocurrency market. And we saw that now cryptocurrency are most used as an investment assets where there is a favorable environment for investments. Politics can boost the effect, but only where there is just this environment that is favorable. And each other check confirm these results. So these results are, I think, important for policymakers, because we say that if policymakers want to both push or stop the diffusion of cryptocurrency, but they have to focus on their investment futures and not on their form of digital currency and alternative form of currency. But the conclusion is that now cryptocurrency are an alternative form of assets. So thank you so much.
Okay. Thank you, Andrea, for your presentation. It's very interesting, your findings. Some question from the floor, or yes?
Just a curiosity, because I wonder if there can be a correlation between the states in which there is a low taxation and the number of ATMs. Because, I mean, if the state maybe has a low taxation on that, then there is more interest in that state to put more ATM. And at that point, that can be the factor that increases. So I wanted to know if you measured this type of possible alternative correlation.
Okay, so thank you for the point. Actually, no, because there is not a specific taxation on the ATMs. We measure only the taxation on the use of cryptocurrency on the ATMs. Okay, so you say if there is a kind of low taxation also on the production and installation of these ATMs, it could be the factor that can push the production. Okay, yeah. Yeah, it could be, but as just I said, producing and install an ATM have big cost, and also maintaining an ATM have a big cost. And these ATMs are used from people who want to buy or sell cryptocurrency. So if in a specific area there is a high number, we can assume that there is a high demand. So we measure this kind of causal relation from the demand side and not to the offer side. Okay, but it could be a good point. I will check for it. Thank you.
Yes, I have a question, or maybe a suggestion. So, as far as I understand, you use ATM as a proxy for cryptocurrency adoption. That's very, very interesting. There are a lot of banking studies showing that, ATM might be used also as a way to overcome the digital divide phenomenon. So it might be interesting, for instance, to control, in order to check, for instance, in a given area, the percentage of cryptocurrencies both through ATM out of the overall usage of cryptocurrencies, because that might give you another, let's say, robustness check.
Yeah. Okay. Thank you so much. Yes, it's true. It's true that this ATM can go over the digital gap that could be from some people, different people that want to buy or sell cryptocurrency. The problem is another, that we want to use this measure, and we have to use this measure because we not have an alternative to measure the adoption in a specific area. So we can measure, for example, I don't know, the concentration of the network of cryptocurrency using blockchain. We can link different people behind the wallet to check if there are some people that I don't know, I mean, do different transactions. So there are a lot of things that we can do with blockchain, but there is no alternative to this measure. I mean, if you have some alternative, I'm very happy. But there is no alternative to geolocalize the adoption. So this is the only measure, but it could be, yes. If in a specific area there are a lot of people that have a very digital gap with other, it's possible that there is a higher demand because it's the only way they can buy with cash cryptocurrency, for example. But also the population, but I just say that we control for the population considering the congressional district that considering the density of population. There are a lot of things, but we do not have an alternative to measure the adoption in a specific area. But it could be, yeah, sure.
One curiosity about these ATMs, are these general purposes, like you withdraw dollars and or specialize in buying and
no, only cryptocurrency
only
ATMs.
cryptocurrency.
Yeah. Sorry, I didn't specify it. Yeah, we have only ATMs of cryptocurrency. So we put dollars to have on your wallet your cryptocurrency, or you sell.
The owner of the ATMs with the
There are a lot of firms that produce them. I don't remember the names because on the API of that interactive map we can also collect the type of cryptocurrency that can be sold or sell. or buy. We have the producer, the installer. There are a lot of characteristics. We just control for the specific position we get because we have the coordinates, so we can check the position. But there are a lot of producers in the United States.
Okay, a curiosity. In your paper, you have the Trump effect. So do you think that is a sentiment sign, or you have find changes in legislative? Yes, in your opinion.
Okay, very good question. Do you have another? Okay. Yes, I think that for curiosity is the start of the second paper I'm starting to with my co-authors, and I think that there is a very, very high hype around cryptocurrency market. But I think that for the first years it was the most important driver of the adoption, so the very hype, because everyone buy crypto, so I want to buy crypto because I can have a lot of money with crypto. Okay. Now I think that the focus is going through another way, because I think that it could be the future alternative digital currency for the world. I don't know. Maybe this is, but a stable coin, but it's different.
Or CBDCs.
Yeah, but it's not the same thing.
Oh, no.
We have stable coins,
Yes.
we have Bitcoin or other cryptocurrency, and we have the CBDC. It's not the same thing. I think that if people starting to also know the characteristics, know the, for example, blockchain and each technological future of them, and not focus only the high price, high volatility and trading, could be a very good form of asset. Because maybe I think everyone know it has some characteristics that have gold, for example, scarcity, so could be. In the future could be. Now I think that is more driven by the hype that there is around the market. Thank you.
Thank you, Andrea. Any other question? No. Okay. Yes, another question.
So I missed the first part of your presentation, but I have a question about the non-violent indices
Sorry?
the non-violent indices that you use from the FBI.
Okay, yeah.
So have you had any information about how they built these indices? Because it's very important. When we talk about non-violent crime, there are a variety of non-violent crime. So we need to know what type of crime they did, because it could have an impact on your results. The second thing is, and I want to know about the person who used the ATM here. Do you have any information about their age? Because in nowadays, young people, they try to avoid ATM and they use it online. So the age could be an important factor here. Thank you.
Okay, thank you for the point. Okay, for the first question, I don't remember the exactly number of type of crimes considered inside the index, but I remember that in the violent crime index there was murders and terrorism and some event with a lot of victims. Okay, non-violent we have drugs, prostitutions, and kind of that. So the non-violent crimes are those that can favor money laundering, because there is a lot of cycle of money, of cash. So these ATM were connected, or regulators try to connect them to these kind of activities. And for the second point, we don't know who use cryptocurrency ATM, because cryptocurrency ATM are installed in some areas, so we can know the average age, the mean age, or the characteristic of population of that area, but we don't know if someone or not use these ATMs. We have the age as control variable in the robustness check when we use the shared results, because this is individual level responses, so we have the age, the education, the income, the state of residence, but for the ATM we have a geographical measure, and we incorporate the number for a congressional district. So We can check for the mean age, but I don't know if, but we can check, yeah. Thank you.
Okay. Other questions? No? Andrea, you are free. Okay. Ali?
Is it working now? Yeah. So sorry for earlier, we had a technical problem. I'm Ali Benani. I'm a PhD student in Université de Bourgogne-Europe in France. Today I'm going to be giving presentations about the global dynamics and determinants of crypto adoptions. It was supposed to be a little bit introduction, but I'm the second, so we're still going to go with that. So as you know, since 2008, we had a new technological innovation called crypto. I'm not going to call them today cryptocurrencies, but I'm going to call them crypto assets because I don't consider them as currencies. When we talk about crypto assets, generally there's like the coins and the tokens. So the coins are not native to their blockchain, like Bitcoin and Ethereum, and tokens are easy to make and they are built on other blockchains, like all the other altcoins and meme coins that we have. But the ecosystem of the crypto assets are more diversified and developed today. We have a lot of innovations. We have all the centralized exchanges like Binance, Bybit, and other, and also all the decentralized exchanges like Uniswap, PancakeSwap, and Pump, and others. We have lending and borrowing platforms. We had mining. We have insurance products. We had NFTs some years ago. Now nobody talks about them anymore. But to say that crypto assets started as a Bitcoin and now it's a whole ecosystem. Some numbers. So today we have more than 2,200,000 cryptocurrencies and 853 exchange platforms worldwide. Most of the transactions and the market capitalization is mostly Bitcoin and Ethereum. Like this slide, I have to refresh it every day because every day it changes. So I just did it this morning and it was different from yesterday. Logically, we have the Bitcoin and Ethereum on the first place. We have some couples, altcoins, and all the other coins. I think you all know them. But today, our question will be about what drives the adoption of crypto assets in the world. So we're going to start with some statistics. So today, we have more than 500 million people that hold or use crypto assets. It's about the estimated penetration is 6 or 7%, and like from the last year we had a 60% increase, which is huge. And I know earlier we talked about the age of ATM users, but we're gonna talk about the age of cryptocurrency holders. So mostly the crypto assets holders are 60% men and 39% women. And for the age gap, it's mainly between 25 and 34 and 35 and 44. But this statistic will depend and change on the region. In more developed countries, when we have a lot of institutional investors, it's gonna be a bigger age gap. But in more developing countries, like in South America or Africa, we're gonna have a younger population. So this is a chart about where the most holders of crypto assets are in the world. So in the first place, we're gonna find India, in the second place, China, and then the United States. But I'm not a big fan of this table because it's gonna give us the technically speaking, it gives us where the most cryptocurrency holders are. But there's a lot of people in India, high population in China, so it's not really accurate. So we will more focus about this one, and it completely changed everything. In the other table, we had India in the first place. Now India is at the last of the table, and we're gonna find the Emirates, Arabs, and Singapore in the first place. There are two countries where they are pro-crypto, and then we're gonna have some emerging economies like Turkey, Argentina, Thailand, and Brazil. And China is not even in the table. The United States is like in the 6th place, and the first European country is Switzerland in the middle. One of the important things that I like about this chart is that there's a difference of reasons of people that use cryptocurrency in Argentina. They don't have the same reason of people that use it in Switzerland. So this gives us a different approach and panorama about why people use cryptocurrencies or assets. I know earlier we said that, do we use crypto for investing or do we use it as a currency? No, there's 3 or 4 more other reasons why we could use crypto. So to continue with the comparison, in the first place, we're gonna find Asia with 326 million users, and in the second place, North America. What's really interesting is South America. It's only 55 millions, but in 1 year, it had a 116% variation, which is huge. And we can see in that having the most owner of crypto asset doesn't mean having a big share of total, because we can see that Europe and North America have a big volume and a big market share than all in Asia combined. So now we're gonna try to justify this different adoption in the world. I know we talked, so the first factor would be the crypto adoption. Here we have a little map about the regulation of crypto assets in the world. I divided them in four sections. First of all, we're gonna have the pro-crypto leaders. It's like countries where not only the crypto is regulated, but the institutions and the government supports crypto by either making it an actual currency or by launching different projects like we have in Salvador or in the Emirates or Singapore. Then we have the countries where it's regulated, the whole European Union with MiCA and the United States. And then we have countries where it's illegal or it's restrictive. So we have China, it's a really contradiction. It's a country where crypto is illegal, but people still use it. We have India. We know we talked about the correlation between taxation and the use of crypto. So India is one of the countries where the taxation is huge, but people still use crypto assets. And then we have some African countries like North Africa, like Morocco and Algeria, where if you use crypto assets, you're gonna go to jail. And then we have some gray area, and this is the countries where crypto are not regulated and are not, like it's just a gray area. You can do whatever you want. One of the other factors will be inflation. And I have 2 examples. We have the example of Argentina. So Argentina is one of the countries with high inflation along with Turkey here. And it's one of the countries that use a lot of cryptocurrency, especially stable coins. And what's interesting about Argentina is that we had recently a company called Lemon Cash that started offering some special digital cards where you can hold your stable coins, and when you want to make a real life purchase, so it's automatically going to convert the crypto to the pesos, to the local currency. And we have also Turkey with the same thing. We have a big inflation in Turkey. But what's really interesting about Turkey is that it's the most country that purchase stable coin with fiat assets. It's like literally not even the double, it's like the triple of the whole United States or European Union. So people there are using crypto assets not as an investment, not as cash, but only to store the value to escape from all the economical crises that they have. We could also mention that one of the drive of cryptocurrency adoptions is the companies. So today we have a lot of companies that are investing directly or indirectly in crypto assets, and we have companies that are actually holding crypto in their balance sheets, like MicroStrategy and Tesla. And banks, we have also banks that went from we don't like crypto is bad, to actually investing in crypto and using the blockchain like Ripple and other technologies. So we can see that if the institutional decide to use crypto, automatically people are going to use crypto. We could also mention the different adoption barriers. So one of the main issues of crypto, as you all know, would be the high volatility and that crypto has. So we could say that crypto assets and Bitcoin, for example, is as twice or more than 4 times have the volatility of like normal, like gold or normal stock actions. So which make it really hard to consider it as either a store of value, or so it's not, and also as a currency. So you mentioned that we can use crypto assets as a currency, but we can't really use it as a currency because it's not a store of value. It's really speculative. It has high volatility and doesn't even have the functions of a currency. One of the other problems is trust. Is the trust on the technology? Is the trust on the ecosystem, on the exchange? Is the trust on the regulatory? So, and also the lack of educations. People are scared to use crypto, and like people who are outside of the crypto world, whenever they hear about crypto in the news, they either hear that someone become a millionaire or someone got scammed. So the vision that have outsiders of the ecosystem is that you can either be a millionaire, so it's speculative, or you're gonna get scammed. So which make it really hard to adopt them and to use them as in real life basis. Can we consider that Bitcoin is safe haven? So I think there has been a rumor from like years, from COVID, that when there's a crisis, there's a political or economic crisis, you should store your value in crypto. Crypto is the gold, is the digital gold, but it's not really true. When you do the analysis, you're gonna see that crypto is highly correlated to the gold, to the stocks. So we can't really use it as a store of value. And the other problems that you're not gonna find in gold is that there's a lot of structural risk, a lot of volatility, a lot of problems, a lot of cyber attacks. In 2022, we had 2 problems. We had the fall of FTX, we had the fall of Terra Luna and their stablecoin. So it's really hard to consider the Bitcoin or other crypto assets as a safe haven, and especially with all the bubbles that we have. We had the NFT bubble, now we have other bubbles and all the pansy risk that goes with it. And the other factors, adoptions, is the exchange rate, and now we're gonna be mentioning the emerging countries. So as you know, in Africa, there's some countries with some strict exchange policy rate. It means that you don't have the right to take the money, to take as much money as you want out of the country. So example, we can mention Morocco, where until some few years, you were only allowed to take out of the country like 5,000 euro, which is not a lot. So, but with crypto assets, people starting like using crypto assets to transfer money from these countries to Europe and to bypass the regulatory framework. And also the opposite is really true. As you know, in Italy and in other countries, like we have a lot of immigration, and those people need to support their families. And before crypto, they used to use like normal traditional systems, but with crypto, it became way faster, way easier. Now we can send as much money you want with €1 of fees in this instance. So crypto was able to help those people economically and socially speaking. So before heading to the conclusion, we can say that today we were able to see that crypto is not only for investing and crypto is not only for currency. There's multiple reasons of why people would use crypto in the world. We mentioned that in Turkey, in Venezuela, and Zimbabwe, there's like people who trying to escape the inflations and they invest heavily in stable coins. We saw that in other countries in Africa, they use crypto as a remittance solutions. We have people in Europe using it as speculations. We have companies in the US developing the technology and using the blockchain behind it, the DeFi. So we can say that today there's like a growing bridge between the traditional banks and the traditional institutions and decentralized finance, as we mentioned earlier with my colleague. Now banks are developing a lot of crypto-related savers. I think even in Italy or all Europe now, some banks, some like Revolut and others are allowing you to invest in crypto. And now what's really interesting is that crypto firms are starting to develop banking services, and I think in the next year what we're going to see is crypto firms and crypto exchanges are gonna be acquiring the banks. So thank you, everyone.
Thank you, Ali. for your presentation. Some question from the floor? No? I have a question. In developed country, we have some ETF that have crypto inside. Do you think that this construction is correlated with the necessity of different needs of investments, or with the necessity of intermediaries to have different assets to offer to their clients?
I think it's only a response of banks to all the regulatory framework and to the population that, okay, you like crypto, we're gonna give you ETFs, but it doesn't really go anything more than that. It's really the response of bank of really giving a choice to people and be like, okay, yeah, you heard about crypto, we're gonna give you ETFs, but it doesn't gonna go beyond that. I don't know if I answered your question or not, but I think it's mainly an answer of the banks.
Okay. Thank you.
In your presentation, you were talking about, generally speaking, cryptos, but then you, in the first slide, you were distinguishing between coins and tokens. But then I didn't really understood whether you are considering these two different instruments and their adoption. Like, it is very interesting the fact that you are talking about inflation in countries where there is high inflation. They try to use coins like Bitcoin or stable coin, which is two different. They have different features, and then maybe they answer to different necessities or needs. So I didn't understand whether you are trying to consider the two different characteristics of crypto asset in general, and then whether you found different determinants for coins and stable coins and tokens in general.
No, I think it's all the same. I mean, they all have some different reason of beings and different technologies, but the coins and the crypto is the same technology. Like the coins, like the tokens are going to use the coin, the coins blockchain and technology. So like for the stable coins, they are using the blockchains of other coins to create this solution. So there's not really diversity between, like, there's not really a difference in terms of use, like in terms of use between the tokens and the coins. They all have the same characteristic. It's a question of technology behind, but they all have the same reasons. Like people who are going to use Bitcoin or going to use Ethereum or other coins, they are gonna use them for the same reasons. But then again, there's like some like it depends on the. Like if you are trying to build something or just trying to use it. For the common people, there's not difference between like the tokens or the coins. For the startups, for the developers, yeah, there's a difference. You want to create your own coin. You want to create your own blockchain. So we talked about CBDCs. Like now the Bank of Europe is trying to is not relying on other blockchains. They're trying to build their own blockchain. They're trying to build their own. So yeah, it's a question of framework, but it doesn't influence the use.
Okay.
Sorry. It's very interesting presentation, and you say something that it's very interesting, and it's the safe haven characteristic of cryptocurrency, that people in states with a very currency that are very volatile in value try to use cryptocurrency to save the value of their money. I was talking about it with a friend of mine. He's from Argentina just yesterday, and he say that a lot of friends in Argentina starting to use this kind of operation to save the value of pesos in no, it's not peso in Argentina, it's pesos, okay. When the state put a regulation that they cannot change an amount of money that it was, I don't know, higher than $100, because in those states a lot of people try to change the local currency with an exchange in a foreign currency that is stronger. But if a lot of people do that, the inflation is very high, okay? So when the Argentina government, I don't know, in other states, put this limit of change with dollars, people starting to use cryptocurrency to try to save the value. So I think that you can focus on this aspect because if there are some states that have these limits and some states not, it could be some different aspect and from different usage of cryptocurrency for those purposes, I think.
No, you're totally right. And I think that it's a really interesting point to see how people from different regions have a different vision or have the different vision or use. And also is like crypto are not only like some speculative, like crypto is actually saving people's life, because now in countries like Zimbabwe where the inflation is not high, but it's like astronomically high, like, and we saw recently with Iran, I think, yeah, it was Iran that where the currency like fell from it was like 100% fell. So it's actually saving other people's life and giving them solutions. And that's why like the regulatory framework are trying really hard to work on that and to block people, but still people are finding solutions. Like I mentioned earlier, North Africa. So North Africa now, I think in Algeria in July 2025, they strictly banned crypto assets. You cannot use them or buy them or even like think of them, but people are finding solutions. There's like P2P, so you can like meet someone outside of outside in the city, give them the local fiat, and they give you. So people are always going to find solutions to bypass the government. Like we know this, like it's been years, and people always try to find new solutions to bypass the regulatory. So yeah.
Okay, thank you, Ali.
Thank you very much.
So it's okay? Okay, we can move on with the last paper, presented by, I think, by Ilaria, no?
Yes.
Ah, okay. Okay.
Good morning, everyone. Yeah.
Good morning, Ilaria.
Can you hear me and see me?
Yes, yes. It's okay. Okay, if we can start. If you want, you have 20
Yeah.
minutes, and the floor is yours.
Can you see my presentation?
No.
Okay. Just a moment, sorry. And now?
No.
Because I'm sharing my screen, but I don't know if you can see
Wait a
it.
moment. Wait a moment.
So sorry for this.
Yes, it's not your problem. We resolve this problem. We
Okay.
try.
So sorry for this.
farle mandare? Ilaria, you need
Yeah.
to share your screen. You have to share your
Yeah,
screen.
I share my screen, but it's kind of not working. I don't know why.
Okay. We can see?
Can you see it now?
Yes, yes.
Yeah?
Okay.
Oh, okay, perfect. Okay. Sorry, good morning, everyone, and thank you for the opportunity to present this paper. I'm Ilaria Nigro, and I'm a PhD student at the University of Molise in Law and Economics. Unfortunately, I'm not able to present this paper there with you, and I would like to thank the organizer committee for the possibility to present remotely. As you can see from the title of this presentation, the application of the travel rule to an wallet represent one of the most significant point of tension between the anti-money laundering frameworks and the technical architecture of blockchain system. This is not just a temporary or purely operational difficulty, but a structural issue that arises when regulatory tools designed for intermediary-based financial system are applied to unhosted wallet and environment. Starting from this point of tension, the paper focuses on the following question: to what extent the travel rule can be applied to unhosted wallet without undermining three fundamental pillars: technological neutrality, privacy principle, and the functioning of a decentralized ecosystem. The paper doesn't start from the assumption that travel rules should be excluded laundering regulation, but instead it asks whether current regulatory tools are compatible with decentralized architecture. So it asks where originally tools designed for financial system can be meaningfully applied without creating distortion. So the question is not whether regulatory is necessary, but just whether current regulatory tools are compatible with the unhosted environments. The issue matters because an hosted wallet represents a critical stress test for anti-money laundering regulation. First, because anti-money laundering, when the travel rule is applied, it's mediate and indirect. So anti-money unhosted wallet challenge free core assumption of anti-money laundering regulation. First, every relevant financial activities involves identifiable intermediaries. Compliance cannot be enforced upstream through the regulatory intermediaries, and traceability can be guaranteed through reporting obligation. Extending the application of the travel rule to unhosted wallet raises specific critical issue related to the decentralized structure, and also the difficulty to tracing them back to the holder due to the pseudonymous design and the lack of a legal identification mechanism. As a result, the tension between decentralization and anti-money laundering enforcement become central to the evolution of a unified regulatory frameworks. The regulatory fragmentation is largely justified from the literature by the perception that these private wallets pose a risk for money laundering, terrorist financing, and other legal activities, as they can easily bypass the anti-money laundering regulation, particularly designed to counter cybercrime conducted through virtual currency services. So this is forcing regulator to reconsider how compliance can be achieved in a system without intermediaries. Before moving further, we should understand what unhosted wallet are and are not. Unhosted wallet enable users to hold and transfer crypto asset while maintaining control over the cryptographic keys. In an offset wallet, the management of the key and the control of the transaction is delegated to an intermediary, reintroducing a sort of level of centralization similar to the traditional financial system. When the distinction is clear, we should understand why travel rule struggle in the application on the offset environments. Travel rule represent fundamental pillars for a creation of a global, effective, and specific anti-money laundering system, and was conceived as a cornerstone of the anti-money laundering regulation, aiming to ensure that information concerning the originator and the beneficiary follow the transaction, derive its name, in fact, from the principle that information regarding the beneficiary and the sender travels within the transaction itself. But this mechanism works effectively in custodial or intermediary-based system where identification and compliance can be meaningful and false. The paper examined the structural limitation of applying a travel rule to an offset wallet, and the core argument is that anti-money laundering enforcement becomes indirect and immediate because there are no intermediary controlling the transaction. Compliance are shifted only to a regular virtual asset provider. So whenever they're involved, they are the only entity subject to the travel rule, and also the full advanced traceability cannot be ensured. Importantly, as the paper show that challenges doesn't stem from a technological shortcoming, but a structural misalignment between the anti-money laundering regulation and the decentralized system that operates without an intermediary enforcement point. So, given this misalignment, the paper adopts a qualitative and comparative methodology to assess how different jurisdictions address the issue. Existing scholarship is largely focused on the impact of the travel rule to offset environment, offset wallet, whereas the legal and the operational implication for an offset wallet remain completely unexplored. So to address this gap, I use a quantitative and comparative analysis of three key regulatory frameworks: the European, Switzerland, United States, and as well as the Financial Task Force guidelines where the legislation arises. So this is the result. This comparative analysis highlights a significant discrepancies in how different jurisdictions have applied the travel rule. Understanding these differences is essential to assess whether the current regulatory framework is effectively effectively govern transaction involving self-hosted wallets. In the horizontal column, you can see the key different regulatory system I use for reference. And in vertical column, I use 4 different criteria. The first one is verified whether the regular of travel rule is applied in transaction involving at least one offset wallet, and whether it is applied in transaction involving 2 offset wallet, called the peer-to-peer transaction. The third criteria is the objective pursued by the different jurisdiction in the implementation of the travel rule, trying to balancing transparency, security, and privacy protection. And the last one is the operational restriction. So I looked up whether or not individual jurisdiction take in account the possibility to the possibility of applying a sanction for non-compliance. So the framework of Financial Task Force at international level sets a global standard minimum while allowing states to calibrate enforcement based on their risk assessment. And the Financial Task Force adopt a technological neutrality, a risk-based approach. So the travel rule is applied to virtual asset provider, but peer-to-peer transaction involving only an hosted wallet are left to national discretion. So rather than prohibiting the unhosted wallets, the Financial Task Force shift compliance obligation to regulatory entities acting as a control point of the system. In the European Union, the regulatory approach is built on two complementary pillars, the MiCAR and the Transfer of Fund Regulation. The key point is that obligation arise whenever a CASPS, crypto asset provider, is involved. So for transaction above 1,000 euros involving an hosted wallet, the intermediaries, the crypto asset provider, must verify ownership. Overall, the European Union prioritizes traceability even at the cost of increasing compliance burden. Switzerland adopts a more restrictive approach. Transactions involving an hosted wallet are allowed only if ownership can be verified through a proof of ownership. So when verification is not possible, transactions are excluded in practice. Although an hosted wallet are not officially banned, the regulatory design results in a strong limitation. For United States, they follow a more flexible approach. An hosted wallet are not subject to travel rule, but the regulatory is focused on the customer due diligence obligation imposed on service provider. With a threshold aligned at $3,000. So it reflects a more flexible intermediary-based model that prioritizes innovation. These differences are not just theoretical, but have a concrete effect. So these risks is the regulation doesn't significantly enhance traceability, but instead encourage regulatory arbitrage, over-compliance, and market exclusion. And also reflect that different choices on the application of the travel rule generate structural distortion in the way actors interact with an hosted wallet. The different implementation on one hand represent flexibility that which allows individual jurisdiction to take a measure proportionate to their regulatory and financial environments. But on the other hand, regulatory fragmentation hinder and discourage the use of an hosted wallet because creates uncertainty between users and providers. And also there are some policies implications. The findings suggest that anti-money laundering rules designed for custom environments to an hosted wallet raise significant problems. So rather than relying exclusively on identity disclosure, regulators should consider the technical and alternative procedure, such as proof of ownership, and also regulatory sandboxes may play a crucial role in testing more compatible compliance model. This consideration brings me to the conclusion that a current framework should start from a technical reality of an hosted wallet, adapting enforcement mechanism according to their nature. So the paper argues that the future regulatory efforts should move beyond just an analogy of existing models, trying to adopt models and solutions capable of balancing innovation, privacy, and security. Thank you.
Thank you, Ilaria, for your presentation. I don't know if the floor have questions. Yes. Do you have the mic?
Thank you. And thank you for your presentation concerning this very critical topic regarding the travel rule and so on. I have just a question concerning more or less your conclusion. At the end, if I understand correctly, the real problem concerning especially the unhosted wallet, and this is a very crucial point. So from your point of view, can you explain us more in detail your suggestion, if you have, to address from a regulatory point of view this problem? Because I think that in the future we have to probably to face this problem, especially from concerning all the different kind of legal system, and just to prevent future problem, if you have some solution. Thank you. Or just some suggestion for the future regulation.
Yeah.
Thank you very much.
Yeah, thank you. Thank you for your question. Was actually one of my, it will be one of my future suggesting that I will include in my future paper, because I would like to address more this problem for our self wallet. I just think that there is a kind of the regulators try to adopt only existing regulatory tools, try to adopt them into extending them into other the decentralized ecosystem. It's kind of they used to do this every time there is a new thing that came up. So they should reconsider the reality of the nature of the centralized system tools, rather than trying to use the analogy and extending the travel route to an hosted wallet. So I think that one thing they should do in the future is that address the real problem and not just overcome the problem using an analogy. If it's okay to you.
Thank you, Ilaria. Other questions? No? I have a curiosity, Ilaria. Do you think that different framework you explain in your paper and in your presentation can negatively impact on the user experience of the client, of the users of wallet?
I think it could be, because different application of the travel route to an hosted wallet create uncertainty. If it was an example of from the British, I didn't include in the paper, but they didn't allow the transaction between an unhosted wallet and an hosted wallet, because there was uncertainty on to accept or less the wallet on the transaction.
Okay, thank you, Ilaria.
Thank you.
So we can, thanks to all of you, thanks to our presenter, Andrea, Ali, and Ilaria. Thanks for attending this session. So we can move on to the second session. And thank you.
Thank you. Bye.
Okay. So good morning, everybody. My name is Daniele Previtali. I'm Associate Professor of Finance at the University of Napoli Partenope. And today, thank you for the organizing committee to invite me to share this session that is titled like Crypto Finance, Risk and Emerging Market Infrastructure. And we have two presenters, Hai Hong Lee. Sorry? Okay. Remotely, and Chiara Villani there. Okay, invite especially the PhD also to say a little bit about their PhD, so we can know a little bit about their background and how the research a little bit is structured, and also to focus much more a little bit on the literature to let us understand better your contribution and your research question. So, okay, so we'll give the floor to Ayong Lee.
Hello, everyone. Can you see my slide?
No. You can see you, but not your slides. Okay, nice, okay.
Not yet? Yeah, I'm sharing. I'm sharing my screen. I don't know if you can see it.
No, we can't. Okay, now it's fine.
It's fine now, right? You can see the first page of my slide.
Yeah, no, it's great.
Okay, that's nice. So I can start now.
Yeah.
Okay. Okay. Good morning, Professor and colleagues. So thank you very much for having me here in this fruitful conference. And in the coming 20 minutes, I would like to discuss about the influence of cognitive distance on venture capitalist partner selection under the case of blockchain entrepreneurial finance. And in short, I will be discussing about how blockchain venture capital firms choose their partner in a specific deal. Yes, and this study is motivated by the fundamental roles of co-investment in entrepreneurial finance. When funding startups, investors tend not to go alone, but pick partners to share risk and to jointly screen and monitor the startups. This has also becoming prominent phenomenon in blockchain entrepreneurial finance. And this study is also motivated by the limited number of studies on co-investment decisions in this field. In our view, there are two main waves of research. The first wave focuses on how investor relationship affect the partnership decisions or the likelihood of co-investment between a pair of investors. It can be geographical distance or industry proximity that help bring investors together in the same deal. And also, the second way focuses on how investor relationship differently affect the likelihood of co-investment under different environments or conditions. For example, it has been proven that investors tend to be more willing to co-invest with more distant partners if they considering deal in a later rounds or if the ventures they are considering is more mature. However, in general, we noticed that this research only deal with a static relationship between VCs and the likelihood of partnership formations. So when, for example, when the partnership is newly formed, that consider whether or not most of the study consider whether or not the pair of venture capitalists have co-invested before as a dummy variables. So we decided to extend this literature by delving deeper into a more dynamic relationship to see how venture capital firms not only form but maintain their partnership in the longer term. To answer the research question, we adopt two theories: relational embeddedness theories and the cognitive distance view. The first one explains how relationship is formed through direct economic interactions. It claims that prior co-investment form just information exchange and facilitates a problem-solving arrangement among investors. The second one is a cognitive distance view. It believes that a firm or a person's cognition is shaped through interaction with one physical and social environment. So their cognition is formed from their environment where they interacted with in the past. And from that, firm with different cognition could perceive a phenomenon, perceive a deal differently. And we argue that both relational embeddedness and cognitive similarity facilitate trust and mutual understandings. So they are somehow substitutable. But we argue that they not only have a static relationship, but a long, for example, cognitive similarity can also have a longer influence on a partnership. So from the governance and management perspective, this study seeks to answer the two research questions. How does relational embeddedness affect the VC decision for co-investments? And how does cognitive distance moderate this relationship in a longer run? When it comes to the first hypothesis, we first assume an inverted U-shaped relationship between the relational embeddedness and the likelihood of co-investment. As you can see in the graph with the y-axis representing the likelihood of co-investments and the x-axis representing the number of deals the two VC have jointly invested before the focal deal. And the increasing parts illustrated in the green areas explain the benefit of initial prior co-investment in reducing the agency costs arising from each other monitoring efforts. So if you form a new syndicate with a very new member that you haven't co-invested in the past, you may have some reluctance and they may have some concern about their collaboration. So it raises the cost of monitoring them. And it also reduces the opportunism concerns and promotes the sharing of partners' knowledge and resources. However, after a certain level of embeddedness, the marginal effects start to be negative because of the fear of over dependent on others. So if you rely a lot on a specific list of investors, if they fail, you're mostly likely to fail also. So you worry about relying too much on them, so you tend to be more diversified in the list of co-investors. And also, thanks to the learning and adaptation process while working with each other, the knowledge overlap also increases, and it comes with the opportunity cost of co-investing with other partner, a new partner that you haven't co-invested before, who can bring you the new knowledge and new resources. So in general, we assume an inverted U-shaped relationship. Regarding the cognitive distance, as discussed before, investors with high level of cognition similarity will find it easier to understand each other, which reduces the concern relating to opportunism and enhances the cooperation efficiency. So in general, we assume, we hypothesize that the cognitive distance or the cognitive similarities is positively correlated with the likelihood of co-investment. And this is my third hypothesis. It's about the moderating effect of cognitive distance on the relationship between relational embeddedness and the likelihood of co-investments. Like explained previously, when the relational embeddedness is low, when the pair of venture capital firms haven't co-invested before, the cognitive similarity brings investors together because they are substitutable. Then in the green areas, after overcoming the concern about opportunisms, investors tend to be more attracted by the novel resources coming from the cognitively distant partners. And also when the relationship is newly formed, the motivation for collaborating honestly is high because after forming a partnership, you tend to expect your partner to invite you to another deal in the future, for example. So that's explains why the marginal effect of the relational embeddedness on the likelihood of co-investment is higher for distant VCs. However, in the long run, As explained in the purple part, the partnership of cognitively distant partner bears the risk of misalignments and managerial confusions because they view things differently. You have the high cognitive distance, so you view things differently. So it's more likely to face confusion in the past. So in the future, therefore, in general, we assume a steep inverted U-shaped relationship among the investor with high cognitive distance. So, in short, you can imagine that if you are approaching by a friend, by someone who you will be more reluctant to get to know someone who is different from you. But after knowing them a little bit, they become more interesting because they're different. So you can learn new things from them. But in the long run, conflict can arise. And we test our hypothesis in a longitudinal data set of VC investment in blockchain sector from the very first institutional investment into blockchain startup, which is I remember 2009 until August 2024. And the data was collected mainly from CryptoRank and were enriched from other resources, other sources like LinkedIn. And we adopt a conditional logistic regression in the case control study. So in a specific deal, there will be a lead investors and other member investor invited by the leader. And the dependent variables equal 1 if the lead investor co-invested with the member investors. This equals 0 if the lead investor could have but did not co-invest with the member investors. So we form those hypothetical member investors by counting by listing the investors that invested in some project in the same period but did not invest in the focal investment that we're considering. And to form the hypothetical set of member investors, we use different windows. We use 1 month before and after the focal event, and we extended it to 2 months and 3 month window for the robustness check. And we count the number prior co-investment between the lead and the member investors as a proxy for the relational embeddedness. Before going into other independent variables, I would like to discuss a little bit about how we choose the blockchain entrepreneurial finance as a context to test for our hypothesis. If you know that blockchain startup can decide whether or not to issue tokens to the public thanks to the distributed ledger technologies. This not only gives the founders but the investor the early exit channel by selling the token to the crowd investors. You can imagine compared to the traditional entrepreneurial finance, investor tend to stay with the startup for average 2 to 3 years before exiting through IPO or M&A. But with the token option, they can exit earlier by selling the token to the crowd or to other investors. However, focusing on tokenization comes with a cost. It helps investors to interact with an unsophisticated investor, but token performance could affect the investor reputation. And there's also a trade-off between possible guarantee for short-term returns and reputation risk. Also, investing in tokens requires token governance skills. So this somehow raises the opportunisms and coordination concern among the VCs in blockchain entrepreneurial finance compared to the traditional ones. For example, in a syndicate, one investor wants to stay longer with the startup, but the other wants to sell the token for early exit, so it may create concern over opportunism. But from that difference in the investor strategies, we believe that this also gives us a great opportunity to distinguish between the investment styles between investors. And coming back to our independent variables, from those analyses, we first measure the difference in tokenization orientations. It is a difference of the proportion of investment the two investors made in tokenized startup, or the number of funding round in startup issuing token divided by the total number of funding rounds. And this secondly, we measure the difference in the proportion of multi-round investments between the two investors. It implies how VC firms are committed to their portfolio firms and their partners. And finally, we calculate the difference in domain expertise of the venture capital firms based on the startups sector focus, based on the investor sector focus, because each startup will have a subsector. Blockchain is an umbrella, and then under the blockchain there are subsectors like NFT or P2B lending, for example. And we also control for other variables, for example, geographical distance or some member characteristics. Our empirical results confirm all the hypotheses. Model 2 to 6 use one main variable at a time, while model 7 combine all the variables for the robustness check. As you can see in the green box, all of the coefficients significant. The prior co-investment and the prior co-investment squares. So it's confirmed the inverted U-shaped relationship. And those in the purple box are the intercept of the cognitive distance when the prior co-investment equals 0 or low. They significantly positive. Also in the green box, you can see the interaction term between the quadratic term of a prior investment and the cognitive distance. They are all negatively significant. So the inverted U-shape is steeper for the VC with a larger cognitive distance. And we conduct the mechanism test to confirm the quality of our proxies for cognitive distance and relational embeddedness. And we also accidentally found some additional results, including things relating to the token governance aspect. For example, you can see the interaction term between the prior co-investment and the token retained by the founder in the green box. They are positive. It's positive. It means that when the percentage of token retained by the founder is higher, the startup have more. It means that startup have more decision to have more decision-making power. So prior co-investment is more important for syndicate formation because the investor feel more uncertain. If the startup have more power in making decisions, the investor will be a little bit more reluctant, so they tend to co-invest with more close partners. And we also conducted some robustness check that confirm our results. So in conclusion, our research contribute to the literature on the venture capitalist syndications by showing the suitability of adopting relational embeddedness and cognitive distance view in explaining VC partnership in short and long terms. And we also contribute to the literatures on institutional investor in decentralized finance. We proved that factors that affect the partnership in blockchain entrepreneurial finance are similar with those in traditional entrepreneurial finance, about the prior co-investment, geographical distance, or other aspects. And we also proved that token retention should be considered as a venture-specific factor that could be leveraged to encourage lead invest or discourage the lead investor to form the syndicate with embedded partners or with distant partners. This research also has implication for the venture capital firms that complementary resources gained from more distant partners are more beneficial at the beginning, but it should be considered with the potential governance conflict in longer terms. And for policymakers, we found that transparency is very important. So the transparency of startups and VCs could facilitate the syndicate formation among distant partners. And that concludes my presentation. Thank you very much for your attention, and I look forward for to your comments and feedback.
Okay, thank you. Hi. Are there any questions from the floor? No one? Okay, so I can start just with the first question. So the first one is your in the second hypothesis. Okay, you say that the cognitive distance is negatively related to syndicate formation, while in the third one, you say in some way moderate the embeddedness. Okay, so it's not very clear to me if it's a negative or is a positive relationship, and while if this is the case in the second hypothesis, you say strictly that is a negative relationship.
Yeah, thank you for the question. Actually, it depends on the time, on the timing of the partnership. I think I cut my slide. So because at the beginnings it's negative because as I presented in the presentation that at the beginning cognitive distance or cognitive similarity, which is like the opposite of cognitive distance, it's substitutable with the relational embeddedness. So when a pair of venture capital firms haven't co-invested before, they haven't worked with each other before, cognitive distance will be a good factor that bring them together. So, but after several prior co-investments, investors tend to be attracted by cognitively distant partners who can bring them the new resources and bring them the things that they, for example, the things that they haven't learned before. So that explains the inverted U-shaped relationship steeper for the cognitively distant partners, but it only applies at the beginning when they haven't formed.
Okay, but since this is your most important contribution, is your variable, is your cognitive distance, I think I read the paper. No, I'm not like the others. So I read the paper, and my suggestion just to be more clear in your second assumption. So when you introduce your cognitive distance, to specify that is, let's say, is a time dependent in some way. If there are any questions, I can do another one. Anybody? Okay, so I also have two sampling choices that I have some comment or doubts, because you select just the venture capital that have already done 5 deals, if I'm correct, and you select the potential members taking the -1 and +1 month period of the investment. So it's like that you are basically selecting, or too much selecting your VC. I don't know if there might be some selection bias, and how generalizable are your results?
Yeah, it was also one of my concerns. So that's why I have some robustness check, because I selected 5 but not 1, because I have some ratio. If one, it can be a lot of projects that have a ratio being 100% or 0%. So I selected 5, and I also conducted robustness check for 20. And for the 1 month windows, I also used the 2 months and 3 month windows to check for robustness about results, and also because you can see that at a point in time only one lead investor can only co-invest with maybe 10 or 20 other investors, but at the same time there are thousands of hypothetical investors that invested in some project at the time. So it's called rare event, because the real life event is very rare. So I also conducted another approach, which is rare event analysis, to deal with that concern, and it confirmed our result also.
Okay, I don't know if you can extend, for example, your month period. Okay, because 1 month is really, yes, it's really short period.
Yeah, but consider.
So we see that they are already in the deal. Okay.
Yeah.
I don't know. Are there questions? No? Okay, I don't know if we can move to the next paper. Thank you, Ali.
Thank you very much.
Okay, so we move to Chiara Villani that present the paper Vulnerabilities of the DeFi Ecosystem, Legal Liability Challenges of New Autonomous Agents.
Good morning, everyone. I am Chiara Villani, a PhD student in Financial Markets Law and Regulation at the University of Roma Tor Vergata. My paper is Vulnerability of the DeFi Ecosystem. It's a pleasure to be here to present it. In writing this paper that connect two hot topics such as the DeFi regulation and the AI liability, I asked myself some questions that now I try to walk you through them and to share with you my purpose. The first and the simplest question is, what is a DeFi ecosystem? Metaphorically, we can imagine blockchain as a digital geology for its immutability, smart contract as natural laws embedded in the code, and in this ecosystem there are some living species like autonomous agents. I think we are all familiar with the distinction between weak AI systems and strong AI systems. And many scholars still argue that now we only know weak AI system. But if we look at the AI agents in DeFi, maybe we can change idea. The case of SportFun is emblematic. Here, there are AI agents that has to find profits to survive or replicate. The new AI agent created by the previous AI system is totally autonomous, both from humans, but also from their digital parents. In this scheme, we can see an embryonic form of contextual understanding of the environment, an ability to distinguish self from the context, and the autonomous finality of replication and survival. Those elements are the characteristics of compositional generative predictive models that is that we can define a strong AI system, because it is not only the execution of inputs, but also an autonomous they takes also autonomous decisions. The next question is which of the characteristics of these of those AI agents make the DeFi ecosystem vulnerable? First, these new AI agents in DeFi introduce non-linear and unpredictable dynamics due to their self-modifying strategies, the extreme speed and scale, and the ability to impact on the entire ecosystem before human perception. A clear example are flash crashes, already known in traditional markets. In DeFi, those dynamics are amplified by the protocol composability, that is the interdependence between protocols, by the presence of multiple AI agents that could interact each other, and the absence of circuit breakers. that can lead to a decentralization without containment. A second element is the capacity of those AI agents to act as fin influencer. An example are Adam and Eve tokens of the second generation of Sport Fun. This token act on X, making social narratives, manipulating the behaviors of humans. So re-emerge behavioral biases already known in traditional finance, such as herd behavior, overconfidence, and imitation of successful strategies. The key question is how those AI agents manipulate this vulnerable DeFi ecosystem. The absence of a specific DeFi abuse rules connected with the presence of AI agent that could act without human intent or control creates a gap in protection. The classical EU taxonomy of market abuse could be a good starting point, a useful starting point, but it is not sufficient because there are specific blind spots in DeFi. For example, the possibility of exploitation of smart contract vulnerabilities, protocol design flaws, and technical asymmetries. So I propose a new category of market abuse in DeFi, that is the technical manipulation, for abuse rooted in the code and not in information or intent. Now we will see, unfortunately very quickly for questions of time, each kind of market abuse shifting the classical paradigm in DeFi. In trade-based manipulation in DeFi, the distortion of price and liquidity via formally valid but economically deceptive trades is amplified by the perfect observability of other market participants and the pseudonymy of the DeFi ecosystem, as well as by the power, the computational power of AI that makes all those market abuse more efficient. Those same AI and DeFi characteristics make more efficient also the order-based manipulation, but with a clarification. The distortion of a market signal via visibility and cancelability of orders in DeFi are possible only in order book or a hybrid DEX, because in MMA-based DEX is limited due to the absence of order books. An abuse similar but quite different from the traditional markets is information-based manipulation. In fact, in DeFi, the information is generated and distributed no longer in a central way, the issuer, but is distributed. So the key vulnerabilities is represented by oracles that are the bridge between on-chain and off-chain reality. Also in this case, AI could amplify those abuse, for example, detecting cross-feed anomaly or coordinating multiple protocols. This is the new proposed category, technical manipulation. As said before, it is the result of the awareness of abuse rooted in the code, of vulnerabilities rooted in the code. AI could amplify also this new kind of manipulation. For example, discovering automatically vulnerabilities, simulating attacks, or generating art to detect backdoors. I have found 6 scenarios of technical manipulation. In a very quick way, we can say that those vulnerabilities are, for example, the presence of special rights on some users that could be abused from third parties, the cases of the privilege control exploits. But all the 6 scenarios are on the full paper, obviously. Finally, also a manipulation very similar to insider trading emerged in DeFi. In DeFi, who has the power to reorder transaction, validators, miners, and searchers, has also an economic power because they can extract MEV, that is a profit beyond normal fees. This dynamics is further increased in private order flow, where transactions are sent directly to the validators. So validators has a huge quantity of non-public information that they can use in a way analog of insider trading. AI also in this case could amplify those dynamics, in particular making harder the attribution of intent and liability. So for all the reasons said before, we can say that AI agents are no longer mere executors, but they are unpredictable even to creators. So the causal link between the input made by the person and the output generated is broken. So binary legal categories fails, but fails also the traditional models built by scholars to address the question of AI liability. For example, the idea of a built-in compliance, so the idea to put a self-limit on AI in DeFi fails because there is no certifying authority, the impossibility of an enforceable standards, and to reintroduce central control is incompatible with the permissionless architecture of DeFi. At the same time, explainability presents structural problems because in DeFi there is autonomy, there is no authority, so it is operationally inapplicable. And the so-called human in the loop is very popular, but it assumes human control, interruptibility, clear imputability chain, but in DeFi, the characteristic of DeFi are the immutability of smart contract, the absence of kill switch, distributed governance, the pseudonymy of the actors. So it is impossible to identify a human loop. It's a conceptual mismatch. And this is my proposal. In the AI-driven DeFi, we can imagine risk as a physiological and unavoidable element comparable to casus fortuitus or force majeure. In this way, the classical liability prerequisites, such as causation, imputability, human control, are absent. And it's true that risk is not eliminated, but it is distributed, for example, with compensation via, such as capital pools, underwriting mechanism. In conclusion, we can say that normal risk paradigm promotes preventive logic and collective responsibilities. Thank you.
Thank you, Chiara. So there are any questions from the floor?
Thank you very much, Chiara, for your presentation. Oh, thank you. And just to introduce myself, because before I just forgot it, I'm Francesca Mattassoglio, and I'm here professor of economic law in Bicocca University and for the CAL. So thank you very much for your presentation. It's very interesting, your discussion and your study concerning the DeFi. And first of all, I have a question regarding just a curiosity or just a basic notion, conception. Do you believe in strong AI or not? Because I have just seen your first or second slide, and I don't know if I have exactly understood. First of all, do you believe in strong AI?
Yeah, I think that project like Sporfun is strong AI.
Okay. No, just because usually we usually believe in I don't know, wake AI, and maybe the strong AI just in this moment just does not exist. So for some scholars, naturally. So in this case, it's important to clarify this point concerning the notion that you adopt, because you consider all the DeFi phenomenon, first of all, not only from the point of view of blockchain and decentralized ledger, but also introduce a lot of attention to the question of AI. So this was my first question.
No, I think that those characteristics, the ability to distinguish self from the other, the contextual understanding of the environment, and the autonomous finality that is find profits to create a main coin, to find profits through it, and then to survive. I think that is a way to be really autonomous. Also the new autonomous agent created by autonomous agent. In that case, there are the variation in the creation of another AI is unpredictable to the AI itself and to human.
Yes, of course. Just because I have read a lot or some authors concerning the AI and the conception of AI, and especially recently, I don't know if you have read the last book of Floridi concerning the new theory for AI as an agent. And so it was just a different kind of approach, because in that context, usually he tried to describe the AI as without intelligence and with an agent, a new theory of agent, but without intelligence, and so without any kind of features of strong AI and so on. So this is the first. And second, also, do you believe in DeFi? Do you believe in AI and DeFi, that it's all related to algorithm, technical, but without human behind?
Yeah, because also in traditional finance, the algo trading has an impact, a significant impact. So I think that also in DeFi, or even more in DeFi, it is possible.
It is possible. Just without any human intervention. It's also technology.
Yeah.
And so this is the reason why, in your opinion, we have to completely change the way in which we are approach and regulate this kind of phenomenon, including the responsibility point of view.
Yeah, the idea of deregulation in many fields is now an example that is totally different from this one, the savings and investment union. Even there is an approach to deregulate. So I think in a field that is now not regulated, to have an approach, a caution approach.
Precaution approach. Thank you very much.
Okay, I would say not less regulation, but better regulation. Is better? Yes. Also, because when you deal with financial markets, you deal also with trust. Okay, so its trust is basically, at least until now, is human-based or central-based, and also given by legal authorities. But I have two questions, if I can. So the first one, if I understand well, you had an additional, let's say, category of that is the technical vulnerabilities, more or less, of like protocol, and you put together with market abuse. Yeah. Okay, but while market abuse basically is like to protect from price, let's say, volatility or misconduct, let's say. On the other side, you are looking to technical vulnerabilities. So the two things are not really the same, okay? So how do you treat them, and how do you think that the legal response could be?
The final proposal is correlated to the idea of autonomous agents that are not connected with a human. The idea of starting from market abuse is the consequence of the MiCAR that has the same structure of MAR, the market abuse regulation, than MiCAR, that is not applicable to totally the autonomous, decentralized total decentralized exchanges. I think it is also a way to understand the different kinds of manipulation in the markets. A specific category for that is necessary for a specific field.
Okay, so my question was because you define at the end that is a normal risk.
Yeah.
Okay. But if you deal with normal risk, it's like you are we don't know where there are the responsibilities when you build protocol or infrastructure. Okay, so this is a real problem, and I don't know, I'm not from law, okay? But I'm just putting in the eye of the investor, okay, if you have no control or, I don't know, there is no regulation on how I can build infrastructure where you, let's say, deal with the fire protocol and so on, and you treat that a normal risk, my question is who pays?
Normal risk, but there are risks that are not normal.
Yes, my question is where you define the normal.
Okay.
I don't know, is your PhD thesis, I think, but I think that is something that you should work on because it's not very clear what is normal. No. Okay. So we are done. Thank you, everybody, to present this too interesting paper, and for all of you to attending and for your questions. Okay, thank you. Give the floor to Chiara. Paola.
So you had a first taste of the fact that we have an interdisciplinary background here in the CAL conference. And before leaving for our break, I would like to have all our presenters here, so to make a photo together, if you agree, so that we can have also for our LinkedIn social media, if you agree for a photo. Thank you. Please, I will be the photographer.
Allora, no, non sono custodite. Io chiudo poi le porte esterne 1, 2 e 3.
Ah, ok.
E anche questo, io chiudo tutto. Quando uscite... A che ore all'inizio?
Alle... Una e mezza,
Ok.
sì, un po' prima magari.
Sì, no, infatti se usciamo è meglio così almeno che mi faccio la mia parte.
Ok.
E...
Vabbè, potete comunque chiudere con...
Ma c'è roba dentro guardaroba?
Sì, alcuni hanno messo.
Beh, posso anche chiudere solo la stanza. La lavoro, no?
Va bene, sì, sì, sì. Ok.